right, well, welcome everyone. On behalf of Benefit Express, we thank you for taking time out of your afternoon to join us for determining full-time status for ACA. This is going to be, it's a very up and popular topic nowadays, so we're going to spend this hour talking about it. Larry Grugine, ERISA attorney, is a great resource. He will pause for questions, and please feel free to ask him any questions. If you'd like, you can use the questions tab in your GoToWebinar toolbar, and I'm happy to ask and receive the answer on your behalf. Also, I sent everyone, I hope you received it, the presentation slides today using the email you registered with. If you need them, they also are in the handouts tab of your GoToWebinar toolbar. If you have any questions about that, you can email me, sryan@mybenefitexpress.com. And our next webinar upcoming is Mid-Year Election Changes Under Cafeteria Plans. That's going to be Tuesday, May 17th at 1 p.m. And you can register for that at benefitexpressonline.com under webinars. We also are recording today's webinar, and we record all our webinars. So if you miss a few or you miss one here and there, you can go to our website. I'm going to email everyone the link in a little bit so you have that for future reference. And I'll turn it over to Larry. Thank you.
Thank you very much, Stacey. Appreciate it. This area is extremely important for three reasons. One, it determines the number of full-timers, determine whether you're a applicable large employer to see if ACA requirements and the employer mandate apply to you. I'll be going, the first part of the program, I'll be talking about that. The second part, which is extremely important, if you are subject to the employer mandate, then you have to make a determination of who is full-time for the employer mandate and also for any reporting. So there is very specified rules in regard to who is full-time. How do you determine full-time status? Even though this has been around for a few years, I still get questions in regard to this. It's very complicated, convoluted, and because it's so important, I think you have to listen to the seminar 2 or 3 times to really understand how these rules work. What also makes it very complicated is that there's a slight difference in the rules between full-time status for determining ALE and full-time status for coverage. I remember one of my clients called me back after we discussed this and said, well, didn't you make a mistake when you said it was 120 hours versus 130 hours? You'll see this in the next few minutes. And I said, no. The definition of full-time status for determining a large employer, applicable large employer, is different. And I don't know why they did this. Of course, I know why, because it increases the number of full-time employees for this purpose. But that's what adds to the confusion for people. And also it makes it extremely important because if you're an employer with a lot of variable hour employees, which I'll be discussing, this is extremely important because now, starting in 2016, you have to offer coverage to 95% of your employees, full-time employees, who are going to be penalized. So if you offer coverage to 94% because you miscategorize a few of your variable hour employees as part-time when they're really full-time and you got audited, that's going to be a huge problem. So you have to get this right, because in the past, in 2015, the threshold was 70%. Starting in 2016, it jumps up to 95%. So this determination is extremely important. So please understand that, and that's why we're going through this, because employers are looking at this, not just for the applicable large employer calculation, but determining full-time and whether you met the 95% threshold, because the fudge part is only 5%, so they don't give you a lot of wiggle room to avoid the $2,000 penalty. So that's why I think this calculation is extremely important. So here, as I said, we're going to look at who is a full-time person for determining whether you're an applicable large employer. And then we're also going to make a determination for coverage purposes. So who do you have to offer coverage to? So let's look at the determination of full-time status for if you as an employer are an applicable large employer. When you're looking at this, remember that a applicable large employer is anyone, any employer that has 50 or more full-time employees, and that is both full-time and full-time equivalent employees. And we always, and generally what we do is to determine whether you're an applicable large employer, you always look at the previous calendar year. This determination is extremely important because once it's determined that you are an applicable large employer, then the employer mandate applies to you. But in addition to that, then you have the obligation to do the 1095s and 1094 forms, the 1095Cs. So if you're an applicable large employer, that's when the obligation gets even more complicated, because now what you have to do is provide a 1095C form for any individual that's considered to be full-time for a month. So the statute defines full-time as anyone who has 30 hours a week or 130 hours. The IRS officials have informally commented that for purpose of applying this monthly measurement, an employer must use 130 hours to identify full-time employees. But, and this is extremely important for determining an applicable large employer, and that's why it's underlined. For this purpose, an applicable large employer is anyone who works 120 hours a month. That's considered to be one full-time employee. And this calculation confuses a lot of people. So they determine whether you're an applicable large employer, and only for this purpose do we use the 120-hour threshold. Now, for this calculation, you'll see this in the next few minutes. What we do here is that if anybody works 120 hours or more, they are considered to be one full-time employee. If somebody works less than 120 hours, then what we do is we total up the number of hours they have for all the non-full-time employees and divide that total each month by 120. That calculation gives you what's called a full-time equivalent employee. And we only use that term for this purpose. Those employees, full-time equivalent employees, are not eligible for coverage. This fiction is only created to see if that employer is an applicable large employer. So remember, an employee is anyone who is considered to be a common law employee. Self-employed individuals or S-corp shareholders are not considered to be full-time. What's also extremely important is that many times you run into companies that have family members. And in some situations, family members of owners are not considered to be common law employees, even though on their own they don't own shares, but since they're husband or wife or son, daughter, or grandson and daughter, they would be deemed to be an owner and therefore would not be counted. And I don't know how many times I've talked to companies that they have a substantial number of relatives working for them. And we have to look at this to see, and many times these companies are on the edge. And by excluding these family members, you could get under 50. Now, full-time equivalent employees are included for purpose of determining LE. You don't include anyone who works outside the U.S. Leased employees, sole proprietors, partners in a partnership, or 2% shareholders are not considered employees. Now, remember, a fiction has been created, and the term is used, 1099 employees, and I get asked this question all the time. Are 1099 employees counted for this purpose? And the answer is no. Don't use that term because it's a misnomer. 1099 employees are independent contractors and therefore should not be counted for this purpose. Extremely important. And over the last 4 or 5 years, more and more employees, more and more employers are using freelancers to fill in the gaps. and are employing individuals that are not common law employees or independent contractors, and they get a 1099. For this purpose, that individual is an independent contractor, not an employee. But again, the employer should be very careful, because even though the employer does not consider those individuals to be employees, the IRS or DOL may, and that's a whole different discussion, but this is one area the government's looking at, because more and more employers, to get out of providing coverage, are increasing the number of independent contractors. So here, so these individuals, leased employees, sole proprietors, partners in partnership, are not considered common law employees. That means they have no obligation to provide them coverage. So as an employer, if you are determined to be an LE, your obligation is to only common law employees. Now, who are full-time equivalent employees? And again, in this situation, any individual employee who, for any month, works less than 120 hours, then they are not considered to be full-time. They are part-time, and then all hours are counted by, again, totaling up the number of part-time hours, and then divided by 120, and for that month, that gives you the number of full-time equivalent employees. So again, for this purpose, determining whether you're an LE, all hours are counted, and the number of full-time equivalent employees employed by employer during a year are taken into account. And so here, for this purpose, all hours are counted. And the only exception to that, and I'll be covering that in the next few minutes, are seasonal workers. And there's a special exception for that. So again, very careful in this situation. You generally count all hours of all employees during a month. If anybody works less than 120 hours, then all the part-time hours are then added together. So the approach of determining how many full-time equivalent employees, you calculate the aggregate hours in a month for the employees that are part-time. You total them up as I indicated before, and then you divide by 120, and that gives you the number of full-time equivalent employees. And then what you do for each month, then you add that figure to the full-time employees to determine how many total number of employees do you have for any month. And again, I just want to stress to you that fiction is only for this purpose. It's only to determine whether that employer is an applicable large employer, and those full-time equivalent employees generally, the employer is not required to offer them coverage. Extremely important. Now, the IRS has provided a multi-step process in determining whether an employer is an applicable large employer. So now looking at days, basically what we do in this situation is look at the average over the calendar year. And we always look at the average over the previous calendar year. So again, and I get this question a lot from employers, they say, well, I got 50 employees, does the employer mandate apply to me? And the answer is no. What we look at is the total over the previous calendar year. And just because you turn 50 in the middle of the month, middle of the year, doesn't necessarily mean you're an applicable large employer, because we take an average over the previous calendar year. So here's the calculation. You calculate the number of full-time employees, including seasonal workers, for each month. Calculate the number of full-time equivalent employees. Use the method in the previous slide. Add the number of full-time and full-time equivalent employees together. Add up the 12-month totals. And then you divide the figure by 12. And if that figure is 50 or more, then you're considered to be an applicable large employer the next calendar year. So all this calculation, we don't care about the renewal date for your insurance. Everything is determined on a calendar year. So you are an applicable large employer for the calendar year. And it means as soon as that calculation is done, the employer mandate applies. There's some special rules that give you a few months to start offering coverage. But again, as soon as you are considered to be an applicable large employer, then what you have to do is then that 1095C requirement comes into play. And the employer mandate comes into play. So this calculation is extremely important. Now, previously, you could use any 6-month period. That went away for 2015, determined in 2014. For 2016, we use calendar year 2015 to make that calculation. Now, there's a special exception in certain situations for seasonal workers. Now, what confuses people, there are two terms that are used here. One is seasonal worker for this purpose, and there's a special exception for employers that rise above 50 for 120 days out of the year. And what this exception does is that it allows the employer to ignore these seasonal workers, but only if they are above 50 for 120 days or more during the year. I'm sorry, 120 days or less during the year, excuse me. Now, employers may apply any reasonable good faith interpretation of what seasonal worker is, but there's another term that confuses people. The other term is seasonal employees, and that purpose is for coverage. The term seasonal worker only applies for this special exception under the law. So an employer with 50 or more full-time employees can avoid the ALE status if the employee's workforce exceeds 50 for 120 days or fewer time during the calendar year. And the employee is in excess of 50 during the 120 days because of seasonal workers. So if you run a business, for example, you owned a number of different Dairy Queens, and during the year normally, you employ 30 people. But during the summer, you employ hundreds of people. And you have Dairy Queens in various vacation areas. And if you did the average, you would be an LE. Well, this special exception here, you can ignore, if you're 50 or more for 120 days, or now if you're 50 or more for more than 120 days, you can't use this. But because of, again, this is a 4-month period, during the year, if you're 50 or more because of these seasonal workers, then what this special exception says is that you can ignore the seasonal workers and only determine your status by looking at your other employees. Stacy, are there any questions?
Yes, I have a couple on my end here. All right, so first one. So if an employee works 27.5 hours, they are considered full-time, or is it still the 30 hours?
It's basically determined on a monthly basis, 120 hours during the month. So for this purpose, for determining ALE, a full-time person is 120 hours in any month. So we're only discussing for that purpose.
Okay. Is there a cap on the number of hours counted in a month per employee for ALE determination when adding all hours together?
No, and again, we only do that. We only do that for those employees that are part-time. If you have an employee, for example, that is full-time, and they work 150 hours in a month, those those hours are not added in, they're considered to be, that individual is considered to be one full-time employee. But you have another employee that works 115 hours in a month. That person is not considered to be full-time, and their hours are then added together with all the other part-time people who work 5, 10, 15, 20, 50, 100 hours. All their hours are added together for the month and then divided by 120, and it creates a fiction called a full-time equivalent employees. And for that month, we add together the full-time number and the full-time equivalent number to determine the total monthly amount of full-time people that are working for that employer.
Okay, last question I have. Husband and wife, 50% ownership and work full-time. Are they considered full-time employees when determining under 50 status?
If they're owners and if they are either partners or 2% shareholders and an S-corp, they're not counted. All right, now if it's a C-corp, they would be considered to be common law employees, and they'd be treated, if they're working 120 hours, they'd be considered common law employees, and they would be considered to be 2 full-time employees. All
Okay.
right?
Thank you, Larry. That's all I have. Let me unmute.
The conference has been unmuted.
Does anybody have any questions? Anyone have a question?
I do.
Yes, go ahead.
On the 120 days for the seasonal worker exception, this is 120 days measuring the employee's employment or the employer's exceeding the employer exceeding the
No, it's how many, it's the time that the employer exceeds 50 or more. So basically what we're looking at is during the year, are they 50 or more for 4 months out of the year?
Okay.
4 months or less.
And then as a follow-up to that, do these days need to be consecutive because you used 120 and 4 months interchangeably there?
No, it could be 2 times. It's 120 days during the year, so they could be, for example, 2 months during the summer and then a month over Christmas. If they exceed 50 over that period of time, I think you cannot exceed 120 hours, 120 days, excuse me.
But if you wanted to slice the bread thin enough, you could go on to a daily measurement in order to take the actual 120, or it's done in whole months?
It's done in whole months.
Okay. Thank you.
Any other questions?
Okay, let me mute, and then you can resume.
The conference has been muted.
And this is the determination of full-time status for coverage purposes. In doing consulting in this area, there are some industries that most of the employees are variable hour employees. They don't work a steady shift. This calculation is going to be, and it's going to be banding for employers to determine who's full-time. And the government recognized it and said, wait a minute, the definition of full-time person is anyone who works 130 hours in a month, 30 hours per week. But we understand in certain industries, somebody may not work a steady shift, depending on the time of the year, the need. Somebody could be working 150 hours in one month and then 20 in the next month. So we have to create a safe harbor that employers can use to determine when an individual is full-time and when the employer has to offer coverage. So basically, you as an employer, what you have to do is divide your workforce into 3 different buckets. Full-time. If somebody always works 30 hours or more, then they have to be offered coverage after they complete the waiting period. So basically that's in a period anywhere between 90 to 120 days. They have to be offered coverage. So if you have employees that always work 30 hours or more, that's the longest they can wait. The second category is part-timers. They never work more than 28, 29 hours. In that situation, as an employer, you never have to offer them coverage. They are not eligible, and therefore, there's no problem. It's those employees, depending on the time of the year, is they could be working 150 or 20. So in this situation, what do? When does that person become eligible? And what the government has done, they've come up with measurement periods that an employer can use to determine when that employee is full-time. Now, when an employee is in a measurement period, and this is important, that employee is not considered full-time. So until that person finishes the measurement period, that individual is not considered full-time. So the employer doesn't have to offer them coverage, nor do they have to provide them with a 1095-C form. And this third category, what we call variable hour employee, is extremely important. So again, employers with 50 or more full-time and full-time equivalent employees must offer affordable coverage with minimum value to anyone who is determined to be full-time. And that is anyone who averages at least 30 hours of service per week is considered full-time and is subject to the employer mandate. Now, again, the IRS guidance addresses how to measure full-time status on ongoing employees and new employees. And they've created enforcement we call safe harbors, that for that third category, the variable hour employee, you can determine when that individual is to be full-time. So, and what the government is saying, if you use these safe harbors and you follow the rules, you're going to be safe. And again, if that person is in a measurement period, that person is not considered full-time. So this is a special calculation, and what's important here is that depending on what safe harbor you can use, if you categorize someone as being variable hour, that person can wait a period of time of 13 months before you, the employer, have to offer them coverage. So you have to be very careful. And when I indicate to somebody is that when that person is hired, you have to put an employee in one of the three buckets. But you don't just set it and forget it. Basically what you have to do, you have to determine after 2 or 3 months, is that person really a variable hour employee? And they have to talk to the supervisor or their manager to say, you know, you look back at the records and that person is always working 35 hours a week. Go back to the manager and saying, wait a minute, you said this person was going to be variable hour, but they're always working 35 hours a week. Are they really a variable hour employee, or are they full-time? Because if the manager says they're much better than we thought, I want to use them as much as possible, and in that determination, then you basically have to offer them coverage. You can't wait to 13 months to offer them coverage. You have to do it right then and there, and you can only wait beginning of the 4th month in order to offer them coverage. So this determination is extremely important. So the guidance creates enforceable safe harbors in order to determine full-time status. An employee is an individual under common, again, the determination only applies to common law employees. And under the common law employee, the employment relationship exists to whom services are performed. So again, this calculation does not apply to anyone who is an independent contractor. that person, again, and basically what we do in this situation is measuring hours. And we measure all hours they get paid for, which includes vacation, holidays, sick time. And again, an employer must offer coverage to anyone who is considered full-time, as anyone who works on average 30 hours per week. Now, if somebody is always working 30 or more hours, it's a no-brainer, and you have to offer them coverage after they complete the 90-day waiting period. Where it gets somewhat complicated is anyone who is considered to be variable hour, and many industries have a number of individuals that are variable hour. These could be part-time or seasonal staff. That individual is considered to be variable hour. Now, for this purpose, and just note here, for this purpose, a seasonal employee for this person is anyone who works 6 months or less for the employer. So if you have an individual that works 30 hours, that works 40 hours a week, but they work less than 6 months for you and they can be considered to be a seasonal employee, then in that situation, that employee is not full-time. They are considered to be variable, and what you can do in that situation is measure them. You can wait to offer them coverage. And many industries have individuals like that work 3, 4, 5 months, 6 months at the most, but they're always working full-time. In that situation, they are considered to be variable hour, and therefore they don't have to be offered coverage. And again, they don't have to be offered coverage until you determine they're full-time. So again, what you have to do is that in all situations, what this slide is trying to say, basically what you have to do is you have to count hours. And you have to count all hours that individual gets paid for. So this includes vacation, holiday, illness, incapacity, jury duty, layoffs. If they get paid for that time, those hours have to be counted. And for employees that are not paid on an hourly basis, and some industries are really wrestling with this, they have to decide what to do. They have to begin counting actual hours, or they can use what's called a day's work equivalency. If they work a day for you, they're deemed to be working 8 hours. You can do a week's equivalent where they are deemed to work 40 hours in a week. But again, you can't use those equivalencies if you know that an individual is working more than 8 hours a day or 40 hours a week. Only if it's based on reality. And some industries had to switch from a per diem and actually start counting hours, because in some situations the number of hours came real close. So again, in this purpose, there are 2 different methods of counting if somebody's full-time. One method is a monthly measurement, where basically each month you look at this and you determine whether that person works 130 hours in that month. So you remeasure them every month, and they can get in and out of coverage depending on how many hours they work. That's called a monthly measurement. And employers are forced to use that if they have not measured employees in the past. The other method is called a lookback method. And basically, if you have to, again, comply with employer mandate on a certain date, you look back and see if that person has completed the requisite number of hours. And I'll be talking about each of those methods in the next few minutes. Now, again, the monthly measurement is easy to use, but it's hard to implement, because basically what you're doing is you're going on a monthly basis. So if somebody works 130 hours a month, they're eligible, And what the law says, you have to offer them coverage at the beginning of the 4th month after they work full-time. And the next month don't work 130 hours in a month, then that coverage, and then the following month, after you offer them coverage, it then is then pulled. I think many insurance companies hate that because you're going to have employees jumping on and off coverage, and they could be horrible. For the look-back method, it's a measurement period is any period of 3 to 12 months. I'm advising most of my clients to use a 12-month measurement period. That's because the threshold of obtaining coverage is high. It's 130 hours times 12, or 60 hours they have to complete. And again, when you're measuring them, that individual is not considered to be full-time. And again, as I indicated, that person can wait 13 months to be covered. So under the month-to-month method, here, you literally each month is a separate period that you make a determination. And again, here you have to offer them coverage the beginning of the 4th month after they work full-time. So literally, again, it could be possible that people could be jumping on and off coverage, and then the months they don't work full-time, you would have to offer them COBRA, which administratively, that's an absolute nightmare. I use this method in only situations where you have an individual that work full-time, then they go part-time. In that situation, then you can pull coverage earlier by using this method. Now, the next period is the look-back measurement period. And there's 2 safe harbors, one for ongoing and one for new employees. So every new employee in this situation would get their own individual initial measurement period. And for anyone who's worked 12 months or more for you, all the ongoing employees are then measured together. These safe harbors are extremely complex, and both rely on what we call defined time periods that you can use. So we're going to use some terms here. First of all, we're going to use the term measurement period. A measurement period is where you measure to see if they worked the requisite number of hours, and that period can be any fixed 3 to 12-month period. Another period that we're going to look at is after you measure them, it's the period that you offer them coverage. So after meeting the minimum hours threshold during the measurement, employee full-time, regardless of actual hours worked, here in that situation is that during the stability period, if they work the requisite number of hours, you have to offer them coverage during the stability period. Another term that can be used is a coverage period. Now, 2 things are very important, is the fact that the stability period generally and the measurement period have to be the same length. There's some exceptions to that, but generally that's true. Now, what's also important is that once you determine someone is full-time, they're deemed to be full-time during the entire stability period, even if their hours dip below 30 hours, averaging less than 130 hours a month. So during that whole stability period, so if you use, for example, a 12-month measurement period, the stability period is 12 months. And what you can do here is then that person is full-time for that entire stability period, even if their hours dip below 30 hours. You have to continue to offer them coverage, and that scares a lot of employers. So you have to continue to offer them coverage. Now, in between the measurement period and stability period, it's called the optional administrative period. That's like the annual enrollment. That period can be any period of time up to 90 days. So once the measurement period ends, you can have a 2 or 3 month administrative period where you offer them coverage. Now again, the term is optional. You don't have to use a administrative period. You can butt up a measurement period against a stability period and offer them coverage, but most employers want a period of time that they want to determine who's full-time, offer them coverage, and then it starts. Now, uniform periods, you can have various periods for various employees for various groups. You can have one period for collective bargaining versus non-collective bargaining, salaried versus hourlies, and in different locations in your country, in your company. You can have it as long as it's employment-based. You can have different periods of time for different employee groups. You could have a shorter period for one group and a longer period for another group. One period does not apply to all employees. Now, for ongoing employees, what it's called is a standard measurement period. And again, it applies to any existing ongoing employees. And in this situation, if you identify an employee as a variable hour employee and they worked for you for at least 12 months, then everyone has to complete a standard measurement period of 3 to 12 months. And again, I'm advising my employer clients to have a 12-month measurement period and a 12-month stability period, where you measure them to see if they're full-time. Now, what you do at the end of the measurement period, that employee, in order to be full-time, would have to work, again, 1,560 hours. It's the total at the end it's extremely important. So if that employee has not worked 1,560 hours, they are not considered full-time and they would not be offered coverage. So for the next stability period, I'm sorry, you're not full-time. We're not going to offer you coverage. But again, in most situations, I would advise a 12-month measurement period. The downside of a 12-month measurement period is the stability period has to be 12 months. Now here's an example how this works. We have a situation, we have a standard that employer has to comply with the requirement, for example, in 2015, in 2014, for example. So the standard measurement period went from 10/15/2012 to 10/14/2013. This is before the final regs came out, but again, we can apply any period. The employer had to comply as of 1/1. So we look back, and the standard measurement period went from 10/15 to 10/14 of the previous year. There was a 3-month. There was a administrative period from 10/15 to 12/31, and then the stability period again was the calendar year. So each year we remeasure. For any employee that is new, we always have a standard measurement period of the same period of time for any ongoing employees. And that measurement period is from 10/15 to 10/14 of the following year. And then here, the stability period would be the calendar year. It's whatever period of time when you have to start, when you have to comply with the employer mandate. But again, you do this every year, and this illustrates how this works. So again, this standard measurement period applies to any ongoing employee that worked for you for at least 12 months. Now, what makes it complicated is that for any new employee, you have to do a separate measurement period. And the second safe harbor applies to any new employees that you hire. Every new employee gets their own initial measurement period. And it starts either their hire date or the beginning of the month after the hire date. So the employers have to establish a separate initial measurement and stability period for any new individual that they hire. And for some industries where they have high turnovers, this is extremely complicated. And they have to make sure, and again, this applies to any employee that you determine to be variable hour. You have to do a separate initial measurement period and stability period. They get their own period. Now, again, this does not apply to any new employee that you expect to work full-time. The 90-day waiting period applies to those employees that you consider to be full-time. It doesn't apply to those individuals that are full-time. This calculation only applies to an employee that is considered to be variable hour. So again, when we have initial measurement and stability periods, as I indicated before, their initial measurement period would begin either on their hire date, the beginning of the month after the hire date, and I would recommend a 11 to 12-month initial measurement and stability periods. That way you can wait at least 13 months to offer them coverage. So several limitations are extremely important to remember. The initial measurement and administrative period cannot exceed 13 months. So the combination of the two. So if you use a 12-month measurement period, the administrative period cannot exceed a little over a month. And the new employee's initial stability periods cannot be shorter than the standard stability periods that apply to ongoing employees. So again, if you're using a 12-month measurement period for ongoing employees, you have to use a 12-month for new employees. Now, once the new employee completes the initial measurement period, and they're tested as full-time, then again, they're offered coverage during the stability period. So they get their own measurement and stability periods. Now, again, if they're not full-time, then basically what happens is, and you'll see this in the next few minutes, then you have to measure them again with all the other employees, and I'll show you that in the next few minutes. So if an employee fails to meet full-time status during the initial measurement, and both conditions, the initial measurement period cannot be more than 1 month longer than the employer's other measurement period. It cannot exceed beyond the standard measurement period. And the employee that meets the full-time status during the overlapping immediately standard measurement period then would get continued coverage, and I'll show you that in the next few minutes. Here's how this works. We have Jim, who started out at 5/10/2014. And this individual employer is using a measurement period of 5/10/2014 to 4/9/2015. That administrative period would go from 4/10 to 6/30. Remember, the combination of the initial measurement period and the administrative period cannot exceed 13 months. And then Jim's initial stability period, and then his measurement period began on his hire date, which is 5/10/2014. His initial stability period runs from 7/1/2015 to 6/30/2016. At the end of his initial stability period, then the employer looks back and throws Jim along with the rest of the employees and their standard measurement period, which runs from 10/15/2014 to 10/14/2015. And then Jim would get coverage if he's determined to be full-time from the end of his initial stability period, which runs from, which ends at 6/30, so he get coverage from 7/1/2016 to 12/31/2016. Jim would have to be then remeasured again if he's a variable hour employee to get continued coverage. So again, you always have these two different measurement periods running. So if you have a lot of variable hour employees and you have a lot of turnover, you have to constantly be measuring people. Now, I would not recommend this initial measurement period starting on their hire date. The next example is Sam, who was hired on the same day, but their employer used a 12-month measurement period, and they decided to start it on the beginning of the month after Sam's initial measurement period. So there's a short administrative period at the beginning and a very short month measurement administrative period at the end, but the initial stability period starts the same at 7/1/2015 and runs to 6/30/2016 at the same time. And then as soon as Sam finishes initial stability period, then the employer looks back and puts Sam on the standard measurement period to see if Sam gets continued coverage from 7/1/2016 to 12/31/2016. So again, this illustrates the two different measurement periods, the two different stability periods running at the same time, and everyone gets one initial measurement stability period, then they're measured with everybody else. Now, there's some special rules when somebody quits. In this situation, if the period for if you hire individuals, there's a period of time. It's for educational, it's 26 weeks. For everybody else, it's 13 weeks. All right. So if somebody's gone for 13 weeks and comes back and they're a variable hour employee, then in that situation, they are considered to be a new employee. So basically what you have to do if you have variable hour employees, you have to establish, and I put it in writing, establish a policy establishing measurement periods, and I would hand out what your policy is to your employees. That's required to put it in writing and make sure the employees understand what your policy is towards measurement periods. But for employers with large numbers of short-time employees, you may want to consider shorter periods, only because the stability period, you could have a 6-month measurement period along with a 6-month stability period. But for most employers, I would recommend a 12-month period. So the employer may want to, again, consider this. Decide whether and how to adjust waiting periods, gather data to determine how and when, which safe harbors are appropriate, consider safe harbor approaches for offering 2016 coverage. If using safe harbors, determine the optimal measurement, administrative, and stability periods, and basically amend plan documents and other related materials, SPDs, to communicate what your policy is. Stacy, do we have any questions?
Yes.
I know that was complicated.
I have a few here, and then we can open it up for everyone. First question, is the seasonal worker exception of 120 days consecutive days or applied to each employee?
No, it's a period of time. No, it's a period of time that you go over. It's not individual employees. It's the number of days that you exceed 50 employees.
Okay. Under the monthly measurement time, hold on one second. I keep getting more and it's shifting me down a line. Okay, under the monthly measurement period, if an employee is previously part-time and then moved to a full-time schedule, can a waiting period be applied, or does this only apply to new employees?
Well, in that situation, if you go from part-time to full-time, basically what this says, you have a choice. You can put them in a measurement period or use a look-back period, or use and if you use a monthly measurement period, if that person goes full-time, you basically have to offer them coverage at the beginning of the 4th month after their status changed.
Okay.
So if you go from full-time to part-time, part-time to full-time, then as an employer you have to offer them coverage no later than the beginning of the 4th month after their status changed.
Okay. Next question. For seasonal employees completed 1,560 hours in prior period, but termed prior to end, then returned during second measurement period, when is coverage offered? At beginning of first stability period or first month following rehire into the stability?
At the date of hire.
Okay, date of hire. Okay. When would you consider a seasonal employee a new hire? When they have 0 hours in the immediate subsequent measurement period following most recent termination?
All right. In this situation, what I would do is, again, I didn't explain it well enough, but I'll indicate there's a special rule that says that if somebody has gone for 13 or more weeks, they are considered to be a new employee. If that seasonal employee is gone for less than 13 weeks, when they come back and they were determined to be full-time, they would have to be offered coverage upon their return. But if they're gone for 13 or more weeks, they come back, then they are remeasured and treated as a new employee.
Okay, thank you. Last question on my end. How is a seasonal employee measured under the monthly measurement method?
What you would do is that each month you'd see how many hours they would work. If they worked more than 130 hours, then you would have to offer them coverage no later than the beginning of the 4th month after they work full-time. For seasonal workers, I would advise against using the monthly measurement, and I would use the look-back period.
Okay, great. Okay, let me open it up for questions.
The conference has been unmuted.
Anybody have any questions?
Yes, I'm wondering how you treat an employee who, during the school year, has variable hours, they're part-time, and then goes to full-time hours over the summer months only.
Well, again, in that situation, if they're a variable hour employee, they could work full-time for a period of time. That's the definition of a variable hour. They work sometimes full-time, sometimes part-time. So what you would do in that situation, and what many employers are doing, is they would collapse the part-time category and the variable hour category and measure everyone who is not full-time. So in that situation, if you have part-time people that sometimes work full-time, you can use a look-back period to determine when they're full-time.
Okay, thanks.
Question again about seasonal employees, terminations, etc.
Hey, Bob. You see me fading here?
Okay, go ahead. I'm sorry. Go ahead.
Okay. So you have a season that lasts 6 months. So between an employee's termination date and rehire date, there's always in excess of 13 months. 13
weeks. If there's an excess of 13 weeks, technically when that person returns, he is treated as a new employee and he's remeasured.
So that employee, even though they may be returning the same time of year, maybe still working similar periods, that employee never has a standard measurement period. They are
Because they're always if they have an absence of 13 or more weeks, they always are considered to be a new employee.
Okay, so they're always in an initial measurement period,
Correct.
never in a standard
Correct.
measurement.
If their absence is 13 or more weeks, That's correct. That's an extreme, and some industries are using that to never offer their employees coverage.
Okay, thank you.
Any other questions? Now, what I would recommend, if you have variable hour employees, I would come up with a policy, put it in writing, and distribute to your employees so they know what the eligibility requirements, that is required under the law. So please, make sure you come up with a policy of when variable hour employees can obtain coverage, and you have to communicate that to your employees. Okay? Are there any other questions? Stacy, thank you very much, and as you can see, it's a very complicated area.
Thank you
Take
so
care.
much. Thank you, Larry. Thank you, everyone. Have a great day.
Bye-bye.